Life insurance. This chapter explores the third type of permanent insurance, universal life (UL) insurance, which evolved after numerous modifications to whole life insurance. Whole life insurance generally offers a fixed death benefit and guaranteed minimum cash surrender values (CSV) in exchange for fixed premiums. While adjustable whole life insurance has a death benefit and premiums that may increase or decrease periodically, these changes are initiated by the insurance company after they compare their actual experience with mortality rates, investment returns, and expenses against their previous projections. The policyholder had no control over these changes. The disappearance of mixed policies and the evolution of adjustable whole life policies ultimately resulted in the creation of universal life (UL) insurance policies. UL insurance combines permanent insurance with tax-advantaged investing within limits. UL insurance is considered to be the most flexible type of life insurance because the policyholder can modify the policy in various ways in the future, as discussed in this chapter. It should be noted that a major reform came into effect on January 1, 2017. It introduced significant changes in the calculation of parameters used for determining the tax advantages of these policies. However, policies issued prior to January 1, 2017 maintain the rights that had been acquired, vested or grandfathered rights prior to the reform. Caution is therefore recommended because a number of changes made to these policies could cause some of the vested rights to be lost under the new rules. 4.1 Transparency through unbundling. With term insurance and guaranteed whole life insurance, the three pricing factors, mortality costs, investment returns, and expenses, are said to be bundled together, and they are fixed for the life of the contract. The policyholder typically does not know what portion of his premium goes towards mortality costs or expenses. With UL policies, the three pricing factors are unbundled and they are not necessarily fixed. Diagram 4.1 shows how money flows through a UL policy. Diagram 4.1. Flow of money through a universal life (UL) policy. UL policies disclose how the mortality costs are applied, how the expense charges are calculated, and any guaranteed investment returns that apply to the policy. This gives the policyholder a better understanding of how the cost of insurance and the expenses vary over time, and how they can impact the cash value of the policy. The cash value, CV, of a UL policy is the value of the investment accounts within the policy. It may or may not be equal to the cash surrender value, CSV, of the policy, depending on whether or not surrender charges apply, as discussed later. 4.1.1 Premium tax. Because UL policies are the hybridization of insurance and investment, contract and sales literature often refer to the amounts that a policyholder pays into the policy as deposits, not premiums. However, for consistency, the term premiums will be used to refer to them in this chapter. Whenever the policyholder pays a premium into a UL policy, the insurance company passes a percentage of that premium on to the provincial or territorial government in the form of a premium tax. Depending on the jurisdiction, the tax ranges from 2% to 4%, and it is charged on the entire premium, not just the portion that covers the cost of insurance. The remainder of the premium goes into the policy's investment accounts. In contrast, if the policyholder were to invest that same money outside of a policy, for example, by investing in mutual funds or guaranteed investment certificates, the amount invested would not be subject to premium tax. 4.1.2 Mortality charges. As with term and whole life insurance policies, the mortality costs for a UL policy reflect the insurance company's cost of paying out the death benefits. For a UL policy, the insurance company deducts these mortality costs from the policy's investment account. The policyholder has some choice in how these mortality costs are calculated, as discussed in the section pricing the insurance component. 4.1.3 Administrative expenses. The insurance company also deducts its expenses from the investment account. These include, for example, the cost of selling, underwriting, and issuing policies, income taxes, the cost of investigating and paying claims, and the profits sought by shareholders. Depending on the insurance company, these expenses might be charged as a percentage of the annual premium, or as a flat monthly fee. Because of the complexity and flexibility of UL insurance, the administrative expenses tend to be higher than for other forms of permanent insurance. 4.1.4 Investment income. The policyholder of a UL policy has considerable flexibility in how investments are made within the policy, as discussed later in the section Investment Choices. And because the policy discloses how the mortality costs and administrative expenses are calculated, the policyholder gets a clearer picture of how the investments held within the policy are performing, based on the changes in the policy's cash value. Investment income accumulates within the policy tax-free as long as certain limits set by the Income Tax Act are not exceeded, as discussed in the section Exemption Test. 4.2 Flexibility for the policyholder. Universal life, UL, insurance is sometimes promoted as the only insurance you'll ever need because it can be highly customized, both at the time of issue and once coverage is already in place. The flexibility can be seen in the following. Black small square timing and amount of premiums. Black small square face amount. Black small square life/lives insured. 4.2.1 Timing and amount of premiums. Within limits, the policyholder can decide how much to pay in premiums and when to pay them. The suggested minimum premiums should be enough to cover the premium tax and the insurance company's mortality costs and administrative expenses for that policy. The minimum premiums are designed to keep the policy in force until age 100, but they are not enough to build up the investment account within the policy. If the policyholder only pays the minimum amount, the policy is said to be a minimally funded UL policy. A significant number of the UL policies sold today are minimally funded. The policyholder can choose to pay an amount that is higher than the minimum premiums when the policy is first issued, to take advantage of the tax-sheltered growth that can happen in the UL policy and to build up the policy's cash value. The policyholder can increase the annual or monthly premiums in the future, but most policies place a maximum on the premiums to ensure the policy maintains its tax-exempt status, discussed in the section Exemption Test. If the policyholder is always paying the maximum amount, the policy is said to be a maximum funded UL policy. The policyholder can also deposit lump sum premiums at any time, again subject to the minimum and maximum amounts specified in the policy. The policyholder can reduce or even stop the premiums for a period of time, as long as the investment account can support the insurance company's mortality and expense deductions. Example: Elaine has a UL policy on her own life. The policy specifies minimum premiums of $325 per month, but she currently deposits premiums of $500 per month, and the policy has a cash value of $2,900. 4.2.1.1 Insufficient account value. A UL policy will remain in force as long as the investment account value is sufficient to support the mortality and expense deductions. There are several key factors that could result in an insufficient account value, which would increase the risk of the policy lapsing. Black small square the policy was always minimally funded. Black small square the policyholder made withdrawals from the policy. Black small square the policyholder decreased or stopped premium payments. Black small square the investment returns were lower than anticipated, or possibly even negative. Elaine is pregnant and she plans to take a 1-year maternity leave from her job, which will result in decreased income for that period. To ease the pressure on her cash flow, Elaine can reduce her premiums, or even stop paying premiums for a period of time. If she stops the premiums entirely, the policy would likely lapse after about 8 or 9 months, $2,900 divided by $325, because the account value would be exhausted by the mortality and expense deductions. 4.2.1.2 Modal factors for UL policies. For term insurance and whole life insurance policies, the modal factors almost always reflect an interest charge that the policyholder must pay to the insurance company in exchange for spreading the premium out over a series of payments. For most UL policies, the modal factor is simply 1 divided by number of payments per year. This means that the insurer does not apply the modal factor to this type of policy. Example: in the previous chapter, an example showed a term policy with a modal factor of 0.088, such that an annual premium of $956 became a monthly premium of $84.12, calculated as $956 x 0.088. Over the course of 1 year, the total premiums would be $1,009.56, calculated as $84.12 times 12, which is 6% higher than the quoted premium of $956. For the majority of universal life policies, Modal factor for monthly payments is 0.0833, calculated as 1 divided by 12. Modal factor for semi-annual policy is 0.50, calculated as 1 divided by 2. In this case, the annual and annualized premiums are the same. 4.2.2 Face amount. The policyholder must select a face amount when first acquiring the UL policy, subject to any minimums or maximums imposed by the issuing insurance company. If the policyholder needs additional coverage in the future, he can add that additional coverage to the existing policy on an attained age basis. He does not have to take out a new policy. However, any increase in the face amount will require the insured person to provide evidence of insurability, i.e., meet certain standards set by the insurance company to prove that he does not pose a significant risk to that company, unless the policy includes a rider for a guaranteed insurability benefit. Riders and the concept of insurability are discussed in later chapters. Life Insurance Chapter 4, Universal Life Insurance 57. Example. Richard and Maria, ages 38 and 42, already have 2 children, ages 15 and 17. Richard has a $500,000 UL policy on his own life. Maria is employed and earns a good salary, and they have no major debts. Richard bought a UL policy a few years ago to ensure that, if he died, Maria would have enough money to raise the children right through their post-secondary education. Much to their surprise, Richard and Maria have just learned that Maria is pregnant with twins. Richard decided to increase his UL coverage by $500,000. He was able to do so within his existing UL policy, after providing proof of insurability. If their cash flow is limited while Maria is on maternity leave and there is sufficient cash value within the policy, Richard may be able to have this increased coverage without increasing his premiums for the time being, as discussed shortly. The policyholder can also decrease the amount of coverage. To minimize administrative expenses, insurance companies will usually restrict increases or decreases to a minimum amount, example, increase of at least $25,000 or decrease of at least $10,000. Changing the face amount can impact how quickly the cash value of the policy grows, because the mortality costs are directly linked to the face amount. If the face amount increases, the insurance company will increase its mortality cost deductions from the policy's investment account. Unless the policyholder compensates by increasing premiums, this will leave a smaller amount for investment purposes and may even erode the policy's cash value. Value. Conversely, if the face amount decreases, the insurance company will decrease its mortality cost deductions and, if the policyholder does not change his premiums, this means more money will be available for investment, which should result in a higher cash value. 4.2.3 Life/Lives Insured. One universal life, UL, policy can be used to insure multiple lives, either on a joint life basis, a single life basis or, depending on the insurance company, sometimes both. Example. Joe bought a UL policy that included $500,000 of joint last-to-die coverage on the lives of himself and his wife, Sherry, and another $1 million in individual coverage on his own life. The joint coverage is payable to the estate of the last-to-die, and is intended to be used to offset the tax liability that will be triggered upon the last of their deaths on certain estate assets they want to leave to their children. The individual coverage is payable to Sherry upon Joe's death, and is intended to help replace the family's lost income if Joe dies first. UL policies may allow the policyholder to add or even substitute a new life insured under the policy, as long as the new person can provide evidence of insurability. Example, Kant. Sherry is no longer able to care for their young children because she was paralyzed in an accident. Joe's sister, Deborah, has moved in with them and she has become an integral and essential part of the family. Joe decided to add Deborah as a new single life insured under his existing UL policy. Deborah had to provide proof of insurability before Joe could add her to the policy. 4.3 Pricing the insurance component. The mortality cost deductions that the insurance company draws from a UL policy's investment account are a reflection of the net amount at risk and the mortality costing method used, as discussed below in this order. Black small square net amount at risk, NAAR. Black small square yearly renewable term, YRT. Black small square level cost of insurance, LCOI. Black small square choosing between YRT and LCOI costing. Black small square guaranteed versus adjustable mortality deductions. 4.3.1 Net amount at risk, NAAR. From the insurance company's point of view, the amount at risk for a term life policy is the death benefit offered by that policy. However, permanent insurance policies, including UL, build up a policy reserve over time, and this decreases the amount at risk for the insurance company. For a UL policy, the mortality deductions are based on the net amount at risk, NAAR, which is calculated as follows. NAAR equals death benefit, the investment account value. Note that the death benefit included in this formula refers to the full amount payable upon death, which could be more than the original face amount of the policy. This is discussed more fully in the section Death Benefit Options. Product owns a UL policy with a death benefit of $500,000 and an account value of $128,000. The current NAAR of his policy is $372,000, calculated as $500,000 to $128,000. 4.3.2 Yearly Renewable Term, YRT. Mortality costing, or cost of insurance, COI, is usually expressed as a dollar amount per $1,000 of risk, or in the case of a UL policy, per $1,000 of the NAAR. Example, Cont. Suppose that for the current policy year, Product's policy had a COI of $18.57. The insurance company would make a mortality deduction of $6,908 from his account, calculated as $18.57 times $372,000 divided by $1,000. For a UL policy, the policyholder can choose one of two ways of applying the risk of death to the NAAR. The first is based on yearly renewable term insurance costing. Recall that, for term insurance, the mortality cost for a period of time is equal to the death benefit, i.e., the amount at risk, multiplied by the probability of death, or the risk that the life insured will die during that period. Yearly renewable term, YRT, is one-year term insurance that renews at the end of every policy year. The annual YRT premium for a specific year is based on the life insured's risk of death for that year. So, for UL insurance based on YRT, the cost per $1,000 at risk generally increases each year because the risk of death tends to increase with age, with the exception of the first few years of life. 4.3.3 Level Cost of Insurance, LCOI. The second mortality costing option is based on the concept of level cost of insurance, LCOI. Recall that LCOI refers to the premiums required by a basic term, to 100, T100, life insurance contract, meaning one without a cash surrender value and without non-forfeiture benefits. T100 premiums are guaranteed to remain level for life because the amount at risk, i.e., the death benefit, remains constant and the risk of death is spread evenly over the duration of the policy. For a UL policy based on LCOI, the cost per $1,000 at risk generally remains constant over the duration of the policy. 4.3.4 Choosing between yearly renewable term, YRT, and level cost of insurance, LCOI, costing. Table 4.1 compares mortality deductions for YRT and LCOI costing methods for a universal life, UL, policy purchased for a 40-year-old healthy woman. 9. Table 4.1, cost of insurance, COI, per $1,000 using yearly renewable term, YRT, versus level cost of insurance, LCOI, costing. For the first 25 years or so. The lower deductions under YRT costing during the policy's early years mean that this costing method provides the best potential for growth of the investment account over the short to mid-policy terms. However, the mortality deductions later in life under YRT deductions can become onerous and may quickly erode the policy's cash value, unless they are offset by high investment returns in those later years. Under LCOI costing, the mortality cost deductions will be greater during the early years, meaning less money left to work in the investment account, which in turn can result in lower account values mid-policy. However, mortality cost deductions under LCOI will be much lower than under YRT towards the later years of the policy, which will help preserve the policy's cash value. Agents should consider the client's goals when helping them choose between YRT and LCOI costing. Black small square. If a client is looking for greater short-term policy fund values, he would likely be better off choosing the YRT costing option, at least initially. Black small square. If a client is looking for longer-term policy values, he would likely be better off choosing the LCOI costing option, because it locks him into a level rate for life. Some policies allow the policyholder to switch from YRT costing to LCOI costing after the policy is issued, but the LCOI rates will be based on the age of the life insured at the time of the switch. The policyholder generally is not permitted to switch from LCOI to YRT costing after the policy is issued. 4.3.5 Guaranteed versus adjustable mortality deductions. The discussion so far has assumed that the yearly renewable term, YRT, or level cost of insurance, LCOI, costing schedule is set when the universal life, UL, policy is issued, and that it is guaranteed for the life of the policy. While this may be true, it is not always the case. UL policyholders would probably prefer the certainty of knowing exactly how mortality deductions are going to be calculated in the future. This is particularly true for YRT costing, which already increases dramatically at older ages. However, the insurance companies would prefer to be able to adjust the COI schedules to reflect their actual experience with mortality, investment returns, and administrative expenses. Agents should understand policies to determine whether the costing schedules are guaranteed for life or subject to adjustment, and they should advise clients accordingly. 4.3.5.1 Open-ended or restricted increases. Where UL policies are subject to mortality costing adjustments, there is a further distinction between open-ended and restricted increases. A policy that allows open-ended increases in mortality costs results in significant risk for the policyholder. Most adjustable policies place a restriction on increases, such as limiting increases to 25%, 50%, or 100% of the original schedule, or a specific dollar amount. 4.4 Death benefit options. Depending on the policy, a UL policyholder can choose from a variety of death benefit options, based on the beneficiary's needs and the policyholder's investment objectives. The most common options are discussed in this section, but insurance companies may offer other creative options. Remember that the death benefit affects the net amount at risk, NAAR, and thus the mortality deductions from the investment account, so the choice of death benefit option can affect the investment performance of the policy. 4.4.1 Level death benefit. The most straightforward option is the level death benefit. Depending on the policy, the amount the beneficiary will receive under this option will either black small square remain constant at the original face amount, regardless of when the life insured dies. Black small square equal the policy's account value once it exceeds the original face amount. Diagram 4.2 illustrates how the policy's account value is equaled once it exceeds the original face amount. Diagram 4.2. Level death benefit option. The level death benefit option is the Diagram 4.2 illustrates how the policy's account value is equaled once it exceeds the original face amount. Diagram 4.2. Level death benefit option. If the policyholder deposits premiums that are greater than the minimum amount required, the policy's investment account will likely grow over time. Recall that the NAAR equals the death benefit minus the account value, so as the account value grows, the NAAR decreases. Because mortality deductions are based in part on the NAAR, this means that the mortality deductions will also decrease over time. These reduced mortality deductions allow the investment account to grow more quickly, which reduces the NAAR. The level death benefit option is the least expensive of the death benefit options, and it is most suitable for clients who do not have an increasing insurance need. 4.4.2 Level death benefit plus account value. The level death benefit plus account value option is somewhat of a misnomer, because the death benefit actually equals the original face amount of insurance under the policy, which remains constant, plus the value of the investment account. In this case, the NAAR remains level over time, while the death benefit increases, as shown in Diagram 4.3. Diagram 4.3. Level death benefit plus account value. Because the NAAR remains level over time, the mortality deductions will be greater than those for a comparable UL policy with a level death benefit, which means the investment account will grow more slowly. However, the beneficiary will receive the original amount of insurance, plus the full account value, as a tax-free death benefit. This death benefit option may be suitable for those who deposit large premiums in excess of the amount required to minimally fund the policy. 4.4.3 Level Death Benefit plus Cumulative Premiums. The level death benefit plus cumulative premiums option tends to be the most expensive option because the beneficiary receives the original face amount plus the gross amount of each premium, i.e., before mortality and expense deductions. This essentially provides a full refund of premiums when the life insured dies. The NAAR equals the original face amount plus the cumulative premiums, minus the account value, as shown in Diagram 4.4. Diagram 4.4. Death benefit plus cumulative premiums. This option may be suitable for policyholders who intend to maximize their premiums, because it ensures that those premiums are not forfeited to the insurance company if they happen to die during the early years of the policy. It also reduces the NAAR fairly quickly, which in turn reduces the mortality deductions and allows the investment account to grow more rapidly. However, if the account value exceeds the sum of the original face amount and cumulative premiums, any excess amount would be retained by the insurance company when the life insured dies. 4.4.4 Indexed Death Benefit. The indexed death benefit option provides a death benefit equal to the original face amount, indexed for some measure of inflation. Some policies index the death benefit to the Consumer Price Index, CPI, while others allow the policyholder to choose an indexation rate when acquiring the policy, usually ranging from 1% to 8% annually. 8% annually. The NAAR for a UL policy with an indexed death benefit will not be level, as shown in Diagram 4.5 below. Depending on the growth rate of the investment account and the index rate chosen by the policyholder, the NAAR, and thus the mortality deductions, could be increasing over time. Diagram 4.5, Indexed Death Benefit. An indexed death benefit might be appropriate to cover an end-of-life risk that is expected to increase over time, such as the tax liability on assets that appreciate in value. 4.5 Investment Components. The investment attributes of universal life insurance are one of the key differentiators between UL and other forms of life insurance. It requires ongoing management by the policyholder. They are discussed in the following order: black small square net premiums, black small square tax deferral, black small square investment choices, black small square impact of investment return on policy viability. 4.5.1 Net Premiums. Whenever a policyholder deposits a premium to his UL policy, the net premium, i.e., the gross premium less the premium tax and the mortality and expense deductions, is invested within the policy's investment account according to the choices pre-selected by the policyholder. As the mortality deductions decrease, the amount available for investment increases, assuming the gross premiums are constant. 4.5.1.1 Exemption Test. One of the key benefits of a UL policy is that it gives the policyholder a way to invest in a tax-sheltered environment. The insurance company may limit the policyholder's net premiums to ensure that the policy remains tax-exempt. The exemption test will be covered in detail in Chapter 7 under Taxation of Exempt versus Non-Exempt Policies. If the policyholder deposits an amount that exceeds the maximum net premium, the excess is directed to a non-exempt side fund, and any investment income earned within the side fund is taxable annually. 4.5.2 Tax Deferral. Investment income earned within the policy's tax-exempt investment account is not taxable at the time it is earned, much like income earned within a registered retirement savings plan, RRSP, is not taxable as long as it remains in the plan. This allows the full amount of earned investment income to be reinvested within the policy. These compounding investment returns can result in significant growth over the life of the policy, and tax on that growth is deferred until the policy is surrendered. Tax on policy surrender is covered in a later chapter. In fact, if the death benefit includes the account value, the growth may never be subject to tax. 4.5.3 Investment Choices. UL policies typically offer a wide range of fixed income and equity investment choices, giving the policyholder the ability to actively manage the investment mix. This is different from other permanent insurance policies, where the insurance company decides how policy funds are invested. The policyholder is not limited to a single investment choice. He can have his net premiums divided or spread out to a number of different investment choices, although some of them may have minimum investment amounts. The policyholder can adjust the investment mix over time, subject to any restrictions imposed by the insurance company, to address changing investment objectives or risk tolerance. The investment choices may vary by insurance company and policy, but some of the common options are listed below. 4.5.3.1 Daily Interest Accounts. Daily interest accounts, DIA, usually offer a minimum interest rate based on the yield of a specified benchmark, such a percentage of the yield on a 30-day Government of Canada Treasury bill. The absolute minimum return is set at 0%, so the principal is guaranteed. 4.5.3.2 Guaranteed Investment Accounts. Guaranteed investment accounts, GIA, offer a fixed interest rate for 1, 3, 5, 10, or even 20-year terms, and they operate similar to guaranteed investment certificates, GIC. As a GIA matures, the proceeds are rolled over into the policy's active investment account, unless the policyholder requests that they roll over to a new GIA of the same term. GIAs typically guarantee a minimum interest rate that is based on a specified benchmark, such as 90% of the yield of Government of Canada bonds with the same term and issue date, less 1.75%. The absolute minimum return is set at 0%, so the principal is guaranteed. A market value adjustment or penalty may apply if the policyholder redeems the GIA prior to its maturity. 4.5.3.3 Index Fund Investments. If the policyholder chooses an index fund investment option, he does not acquire a legal interest in the index fund, or in the securities that make up that index. Instead, interest is credited to the policy's investment account based on the performance of the chosen index. Because market performance fluctuates, the interest can be positive or negative. Agents should ensure that the policyholder understands that this means that it is possible for the investment account to decline in value. Index options may be diversified by location, asset mix, example, equity, bond, balanced, market capitalization, example, large cap, small cap, or income objective, example, capital growth versus income. Index account options may be subject to management fees, which will reduce investment performance. 4.5.3.4 Mutual Fund Investments. UL policyholders may also choose to receive interest income that is based on the performance of a selection of mutual funds. Because market performance fluctuates, the interest can be positive or negative, meaning that it is possible for the investment account to decline in value. Mutual fund options typically represent a range of management styles and asset mixes, including Canadian, American, and global offerings. Mutual fund options may be subject to management fees, which will reduce investment performance. 4.5.4 Impact of investment returns on policy viability. While UL policies unbundle premiums, mortality deductions, expenses, and investment returns, this does not mean that these factors operate in isolation. In fact, they are interrelated and must be kept in balance for the long-term viability of the policy. For example, if mortality deductions increase, the investment account will grow more slowly or even decline in value, unless either the policyholder deposits additional premiums or investment returns increase. Similarly, if investment returns are lower than expected, then the mortality deductions will erode the account value more quickly. If investment returns are negative, which is a possibility if the policyholder chooses to base his interest income on index funds or mutual funds, then there is a very real possibility of the policy lapsing, unless the policyholder deposits additional premiums. 4.5.4.1 Policy Illustrations. UL policy documentation typically includes a policy illustration, which is a chart or table that shows projected values for the premiums, mortality deductions, investment account value, cash surrender value, and death benefit for each year in the future. However, these projections are only intended to demonstrate how the policy works and are not a prediction of guaranteed or expected performance. UL policy outcomes are very sensitive to even small changes in investment performance, particularly over the long life of these policies. To highlight this sensitivity, most policy illustrations now include at least two sets of projections. The first will be at the current or requested rate of return, and second will be based on a slightly lower rate of return. Policy illustrations are usually accompanied by strong disclaimers, and agents must ensure that policyholders understand that the projections are not predictions of future performance. In fact, the policyholder is typically required to sign the illustration, acknowledging that he understands the limitations of the illustration. 4.6 Accumulating Fund. The investment account or accumulating fund of a UL policy plays the same role as the accumulating fund within a whole life policy, in that it can provide the policyholder with a number of non-forfeiture benefits, including those discussed below. Black small square surrendering the policy. Black small square policy withdrawals, partial surrender. Black small square premium offsets. Black small square policy loans. Black small square collateral for third-party loans. Black small square leveraging. Black small square distribution upon death. 4.6.1 Surrendering the policy. If a UL policyholder no longer needs the coverage provided by the policy, he may want to terminate or surrender the policy. Upon surrender, he is entitled to benefit from the funds that have accumulated within the policy's investment accounts. The amount he will receive is the cash surrender value, which is the cash value of the investment account, less any applicable surrender charges. Generally, surrender charges are normally charged if the policy is surrendered during the first 5 to 10 years of coverage. They are intended to both encourage policyholders to keep their policies for the long term and compensate the insurance company for the expenses associated with underwriting and issuing the policy. UL policy surrender charges are usually calculated as a multiple or percentage of the annual mortality deduction that would apply under LCOI costing. That multiple or percentage gradually decreases over time until it is completely eliminated. However, the surrender charge would never exceed the value of the investment account, so the policyholder will not have to pay a surrender charge if the policy does not have a cash value. Example: Fiona recently purchased a UL policy, and she wants to know what her options are for surrendering the policy in the next few years. The annual mortality deduction that would apply under LCOI costing is $500, and a surrender charge multiple applies for the first 10 years of the policy. The following table shows how the surrender charge would be applied, based on the assumed policy cash values. Policy year. In most cases, surrendering a UL policy will result in a taxable policy gain. Taxation when surrendering or disposing of a life insurance policy is discussed in a later chapter. 4.6.2 Policy withdrawals, partial surrender. A UL policyholder can also withdraw funds from the policy. A withdrawal is considered to be a partial surrender, and it may result in taxable income to the policyholder, as discussed in a later chapter. The insurance company may impose a minimum withdrawal amount, and the maximum amount is the policy's cash surrender value. Surrender charges may also apply, depending on the contract and the timing of the withdrawal. The funds come from the policy's investment account, which is used to pay the policy's mortality and expense deductions. As a result, withdrawals will impede the growth of the investment account and may affect the long-term viability of the policy. Example: Andrew has a UL policy with a level death benefit of $200,000 and a current cash value of $21,000. The policy is based on LCOI mortality costing, with mortality deductions of $3,800 per year. Andrew lost his job and he is running short of funds, so he is thinking about withdrawing $20,000 from his UL policy. While his contract allows the withdrawal, Andrew should know that it would reduce his death benefit to $180,000, and the cash value of the policy would decrease to only $1,000. This puts the policy in danger of lapsing because there won't be enough money in the account to cover the next mortality deduction of $3,800 unless Andrew can deposit additional premiums before the deduction comes due. 4.6.3 Premium offsets. Participating whole life policies provide the policyholder with the choice of using policy dividends to offset their premiums. Because of the way the investment account of a UL policy works, premiums are naturally offset by investment income and the policyholder's deposits to the investment account. Depending on the premiums deposited into the policy and the investment returns earned within the policy, the investment account can grow to such a size that it can be used to fund future mortality and expense deductions indefinitely. In other words, the policyholder can stop paying the premiums while maintaining his policy in force. Walter bought a $500,000 UL policy several decades ago, based on LCOI mortality deductions of $10,500 annually. Walter always deposited the maximum premium permitted to the policy, and he has made some rewarding investment choices. As a result, the policy currently has a cash value of $460,000. Because Walter is currently 65 years old, he could stop paying premiums and the policy would likely remain in force for the duration of his lifetime. However, if he wants to do this, he should adjust his investment mix within the policy to those investments that offer a principal guarantee. 4.6.4 Policy Loans. As with whole life insurance policies, the UL policyholder can usually obtain a loan from the insurance company against the cash surrender value of the policy. The loan is limited to a percentage, typically between 50% and 90%, of the cash value. The interest rate will be set at the time of the loan. The policyholder is not required to pay back the loan, but the loan balance plus any accumulated interest will reduce the death benefit payable under the policy. A policy loan is also considered to be a taxable disposition, which may result in taxable income to the policyholder, as discussed in a later chapter. Example: Joshua had a UL policy that named his daughter Rebecca as the beneficiary. The policy had a $250,000 level death benefit and a cash surrender value of $35,600 when he took a policy loan of $30,000 at an interest rate of 4% annually to help pay for her post-secondary education. By taking the policy loan, Joshua also had to report taxable income of $1,800, according to the information provided by his insurance company. 1 year later, Joshua died. Assuming he did not make any principal or interest payments on the policy loan, Rebecca would receive a death benefit of $218,800, calculated as $250,000 to $30,000, $30,000 times 4%. One of the advantages of taking a policy loan instead of simply withdrawing money from the policy is that funds continue to earn tax-sheltered income within the policy's investment account. However, the interest rate charged on a policy loan may be higher than the return on the funds. Life Insurance Chapter 4, Universal Life Insurance 72. 4.6.5 Collateral for third-party loans. If the UL policyholder wants access to the capital within his policy but does not want the taxable disposition that would result from either a withdrawal or a policy loan, he may be able to use the cash surrender value of the policy as collateral for a loan from a third party. In this case, the loan arrangement is usually made with a financial institution, which may require additional proof of assets or income before granting the loan. Depending on the arrangement, principal and interest repayments may or may not be required. However, the full cash value stays in the policy, where it continues to grow on a tax-sheltered basis. Example: Cont. Suppose that instead of taking out a policy loan of $30,000, Joshua had taken a 5-year loan from his local bank at 4% interest, using his UL policy as collateral. At the end of the first year of the loan, Joshua made a repayment of $6,738 to the bank, $5,538 principal, $1,200 interest. When Joshua died 1 year after taking out the loan, the bank received a death benefit of $24,462, calculated as $30,000 to $5,538, and Rebecca received the balance of $225,538, calculated as $250,000 to $24,462. 4.6.6 Leveraging. Leveraging is a variation of a third-party loan. A UL policyholder may be able to obtain a loan, or series of loans, from a bank, where the cash surrender value and death benefit are used as collateral. In this case, the principal and interest generally is not repaid while the life insured is living. The accrued debt, i.e., the principal plus accrued interest, is discharged only upon the death of the life insured. These loans are not taxable, so the policyholder can then use the full amount of the loan, or series of loans, to invest elsewhere, or to supplement his income. If the proceeds are invested to produce property income, i.e., dividends, interest, or rents, the loan interest being accrued against the policy loan is even tax-deductible to the policyholder. Example: Wendy has a UL policy with a $500,000 death benefit and a CSV of $260,000. She retired at 55, earlier than anticipated, and thinks she may need to draw on her UL policy to support her retirement income until her CPP and OAS benefits start. However, if she simply withdraws the money from the policy, it will result in taxable income. Instead, she approached a bank about receiving a loan of $10,000 each year for 10 years, using her UL policy as collateral. She will receive the loan proceeds tax-free, resulting in greater after-tax income than if she had withdrawn $10,000 from the policy each year. Life Insurance Chapter 4, Universal Life Insurance 73. This can be a dangerous strategy if investment returns are lower than anticipated. UL policyholders who leverage their policies should pay close attention to how quickly loan interest is accruing, relative to the investment growth within the policy and the mortality and expense deductions. If the value of the loans plus accrued interest exceeds the cash surrender value of the policy, the bank may decide to demand repayment of the loan. If the policyholder does not have any other funds to satisfy this debt, he could be forced to surrender the policy to pay off the loan, leaving him uninsured, and with a potential tax liability as well. Example: Count. Wendy will need to monitor the investment returns earned within the policy to ensure that the loans and ongoing mortality and expense deductions do not reduce the policy's cash surrender value to the point where it is less than the outstanding loans plus accrued interest. 4.6.7 Distribution upon death. What happens to the investment account, i.e., accumulating fund, within the UL policy upon death of the life insured depends on the death benefit option provided by that policy. As discussed earlier in the section Death Benefit Options. Black small square under the level Death Benefit Option. The insurance company usually only pays out the face amount, although some policies will pay out the value of the investment account that exceeds the policy's face amount. Black small square under the level Death Benefit Plus Account Value Option. The policy will pay out the original face amount, plus the full value of the investment account. Black small square under the level Death Benefit Plus Cumulative Premiums Option. The policy will pay out the original face amount, plus the sum of all of the premiums, regardless of the value of the investment account. Any excess that may remain in the investment account is retained by the insurance company. Black small square under the Indexed Death Benefit Option. The policy will pay out the original face amount, indexed according to the rate specified in the policy, regardless of the value of the investment account. Any excess is retained by the insurance company. 4.7 Advantages and Disadvantages of Universal Life, UL, Insurance. The advantages and disadvantages of UL insurance are summarized in Table 4.2. Table 4.2, Advantages and Disadvantages of Universal Life, UL, Insurance. Advantages, Disadvantages. Black small square offers considerable flexibility to the policyholder. Black small square policyholder can increase, decrease, or even suspend premiums, as long as the policy's account value can support the mortality and expense deductions. Black small square policyholder has a choice of investment products. Black small square offers the opportunity for tax-sheltered investing, within limits. Black small square product is complex and may be difficult for the policyholder to understand. Black small square policyholder needs to actively monitor the performance of the investment account and make adjustments to policy investments as needs change. Black small square entire premium is subject to premium tax. Black small square policy performance is sensitive to changes in investment performance. Life Insurance Chapter 4, Universal Life Insurance 75. 4.8 Comparing Universal Life, UL, and Whole Life. Table 4.3 summarizes the differences between whole life insurance and UL insurance. Table 4.3. Whole life insurance versus universal life, UL, insurance. Universal life insurance, whole life insurance. Insurance. Mortality deductions and expenses. Black small square mortality deductions and expenses are deducted from investment account. Black small square mortality deductions may be based on YRT or LCOI costing. Black small square mortality deductions and expenses are taken from policy reserves. Premiums black small square A missed premium does not trigger a premium loan, mortality deductions and expenses continue to be drawn from the investment account. Policy may lapse once the account value becomes insufficient to cover these deductions, subject to grace period. Black small square premiums are typically level for the life of the policy, unless it is an adjustable policy. Black small square A missed premium will trigger an automatic premium loan. Black small square additional automatic premium loans will be made until the CSV becomes 0, when the policy will lapse, subject to grace period. Dividends black small square does not provide policy dividends. Black small square policy may pay dividends. Death benefit black small square policyholder has options with respect to the death benefit, example, death benefit plus account value, death benefit plus cumulative premiums. Black small square death benefit is generally not affected by the value of the investment account. Modal factors black small square modal factors generally are not used. Black small square modal factors apply if premiums are paid other than annually. Investment black small square policyholder can choose how the investment account is invested. Black small square insurance company chooses how the policy reserves are invested. 4.9 Using Universal Life, UL, Insurance. Universal life insurance is most appropriate for an investment-savvy policyholder who has long-term insurance needs and who is also looking for tax-advantaged investment opportunities. This section provides a few examples of when UL insurance might be appropriate. 4.9.1 Maxed Out Registered Retirement Savings Plan, RRSP, and Tax-Free Savings Account, TFSA. Universal life insurance policies may be attractive to people who have already maxed out their RRSPs and TFSAs, especially if they have a high marginal tax rate. From a tax efficiency standpoint, repayment of non-deductible debts before using UL insurance policies for investment purposes is also recommended. Example: Alistair is 45 years old and a senior project manager at an engineering company. His company offers a defined benefit pension plan, which severely limits his personal RRSP contribution room. He has already maxed out his TFSAs, and he is looking for additional tax-advantaged ways to save for retirement. He also wants $500,000 of life insurance coverage to create a scholarship fund upon his death. Alistair may be interested in a universal life insurance policy. If he maximizes his premiums to the policy, the investment account will grow tax-free. If he chooses a UL policy that pays out the death benefit plus account value upon death, the entire amount will be paid out tax-free, leaving an even larger legacy. 4.9.2 Tax-free retirement income. Leveraging a UL policy can provide a tax-free source of retirement income. Example: Joan expects to be in the highest marginal tax rate during her retirement, so she is looking for sources of retirement income that will not be subject to tax. She has already maxed out her tax-free saving account, TFSA, and does not want to put more money into registered retirement savings plans, RRSP, because the withdrawals will be highly taxed due to her marginal tax rate. She can maximum fund a UL policy, which will provide tax-free investment growth. During retirement, she can obtain a series of loans, using the policy's cash value as collateral. Because she won't actually be withdrawing the funds, no income tax is triggered. Furthermore, the investment account remains intact, so it can continue to earn tax-free income. Life Insurance Chapter 4, Universal Life Insurance 77. Chapter 5, Riders and Supplementary Benefits. Competency Component Black Small Square Analyze the available products that meet the client's needs. Competency Subcomponent Black Small Square Analyze the riders that meet the client's needs. Life Insurance Chapter 5, Riders and Supplementary Benefits 78.